Good morning. Welcome to episode 4 of Scott and Sam in the AM. If you are not already, make sure that you are following us on Spotify, Apple Podcasts, anywhere else you get your podcasts, as well as Facebook, YouTube, and most importantly, Instagram at Scott and Sam Real Estate. Scott, good morning. How are you?
Good morning, Samuel. Good to see you this morning. So what's going on?
Not too much. Didn't hit the gym this morning. Panicked as soon as I woke up, came right to work. Feel like I have a lot more to do than I probably actually do. Regular old Wednesday.
What are you
I want
panicking
to dive
about?
right into today
I wanna hear
talking
more
about what we
this.
should be talking about, which is real estate. And we've been getting a lot of DMs from our posts, a lot of young Scott and Sams, too naive to know their own good with big ambitions and big goals. We got a couple people who reached out this week and had a really good point of, I live in a wealthy area. I'm either from this area or I chose to live here, which is pretty normal. Wealthy areas, for the most part, probably have more going on. They're safer. They're more enjoyable. I don't blame you. I live in a pretty wealthy area. Can't afford to invest in my area. You are actively looking to move to a really wealthy area and can't afford to invest where you want to move. So the number one question is, how do I buy real estate? How do I make a living investing in real estate, living in a wealthy area?
Some of the biggest real estate investors, pretty much all of them, they all live in wealthy areas, right? Manhattan, LA, Miami. A lot of those guys invest, in their backyards for sure. They expect different returns. But if you're just getting started, which I think that's, who we're talking to right now, guys just like me and Sam, we focus on areas within about an hour drive in every direction from where we live. I don't typically look for deals that are in my neighborhood. Now, if they come up, they could be worth pursuing later on in your career because you're going to probably bank more on appreciation than you would on just straight cash flow or being able to flip those houses. But if you're just getting started, let's focus on areas where they're safe, blue collar towns, where home prices are in the median range. And I would say on the high end, after a fully renovated house goes for $400,000 in some areas, that's what I would focus on. You buy it for 2, you sell it for 4, right? You put $100,000 into it. And that doesn't mean you're making $100,000, by the way. Any investors out there, they know that. That's the idea, right? You buy it for $150,000, you sell it for $3,000, something like that. That would be what
I think the most important factor above anything else is density and demand. If you live in a dense area, and if you're living in a wealthy market, you're probably in a major market. Like we've talked to people from Northern Virginia, outside D.C., Boston, New York, a lot of parts of northern New Jersey. Talked to people in Seattle. These are extremely dense, well-populated markets. It's not like you're living in Bisquick, Idaho. You probably have some of the best investment real estate in a mushroom around the major metropolitan area. That's where you need to look. A lot of the best deals we're buying are, I live outside Philadelphia. A lot of people know it as the main line of Philadelphia. And where I live is nearly impossible to buy a house for less than $450 a square foot. Renovated ones can go for significantly higher than that. It's not feasible or affordable for the average Joe or Jane to start flipping houses in those neighborhoods. We just put a bid in on a flip in my neighborhood, and we went in $25,000 over asking. We waived everything, and we still lost to another investor by $30,000. And that guy's probably going to make $250,000 in that deal. We should have gone higher. Scott wanted to go in higher, and we would have won it. And I said no, and he's right, I'm wrong. But I think density is the number one factor, because if you're in a dense market and you're extremely well populated,
and that sales price was $750, so people understand.
$750, right? And the winning big bid went in at $780,
which is not what we typically do. It would be a riskier flip for us for sure. But in the right markets, that's what I was talking about. It's worth considering when those deals do come up once in a while. They don't come up a lot because a lot of those houses change hands between each other, family members, they stay in the family, and then a lot of times they end up on the market anyways, and then a homeowner is willing to buy that, pick it up, fix it up themselves, and live there because it's such a good neighborhood. That's something that I would do personally, Sam would do personally just for their own home, and they pay more than we would because they're not looking for $200,000 profit. They're just looking for a nice house that's done to their standard.
But if you're in a well-populated market, there's probably a lot of demand. There's a reason why a lot of those people live there. You're never going to hear the two of us tell anyone to buy properties in low-end areas. I've never going to be the guy to tell someone like, yeah, buy that $40,000 row home in South Philly. The good thing is we have done a little bit of everything over the last few years, everything from owning and managing single families. We're going to build up a bunch of cash flow this way, burning duplexes this way, we've done it all. I can't think of a real estate strategy that Scott and I have not done from start to finish and either made money or lost money on, and you learn from those experiences, and then you take little pieces of them, and now you apply them on an RV park or a big commercial deal and all that stuff. But the number one thing I can tell you for certain is you do not want to get into managing and owning cheap properties in bad areas that are not going to appreciate. You're going to have a really tough time with your tenant base, most likely. And if you do the math on the amount of money you're still going to have to keep shoveling out in management and maintenance and evictions and all this stuff, you're better off just buying the price point that Scott's talking about, $200,000-$300,000 with an ARV of $400,000 or $500,000. There's still so much demand in that area, and you're going to have a way better tenant class, way better resale, demand. You're going to be working in better areas. When we used to do properties, flips in tough areas when we started, there's so much you got to worry about. People breaking into your job site. You get a dumpster, it's filled in 24 hours with everyone in the neighborhood throwing their stuff in there. When you are flipping in $300,000, $400,000, $500,000 neighborhoods, they're usually tucked back. You got your own driveway. It's a nice yard. Kids are playing basketball in the street. It's just a nicer way to go about it, and that's the kind of stuff you want to own and invest in. Now, when Scott talks about us bidding $750,000 on a flip, keep in mind we have 12 active flips right now. It's not like we would be all in on that with all of our money sunk into this one deal. I hear these nightmare stories of people going for broke because they went all in on one real estate deal. That'll never be us. We're going to always be diversified and have mitigated risk across everything we're doing.
Let me clear something up, though. You're bouncing around a little bit between rental properties and flips.
Yep, I do that, yeah.
I'm not saying buy a $400,000 house as a rental property. I'm talking strictly as active income here. Real estate is a long-term play if you're not flipping houses, and you need a way to have some active income. So whether you have a good job and you buy real estate for the long haul, but if you're like us, we don't have jobs, right? Show up every day and we try to make money, right? It's the only way we pay our bills. And when we buy a nice, stabilized asset in a good area, guess how much money we're making off that? Not enough to live, okay? So we need active income, and those things are retirement. So for let's back up a little bit for the first person who's trying to buy their first investment property, set themselves up for the long haul, which can absolutely change your life. It can be a retirement vehicle for you. Go out and buy a multifamily with 3.5% down. I know we talk about it all the time. I'm the 3.5% down guy. That is the damn holy grail of getting started in real estate. And don't worry about, unless you already own a home, focus on that first and then flipping later.
Can I make one exception to this that I think you'll agree with? Mm-hmm. On Friday last week, shout out Will and Davis in Nashville. I did a 2-hour-long call with these guys. These guys have a bright future. In 10 years, they're going to be, Will and Davis Real Estate is going to be bigger than Scott and Sam Real Estate. These guys, they're best friends since middle school, graduated college, I think, a year and a half ago, and bought a house in Nashville on the market. They paid I think $450,000, $500,000 for it. They got an FHA loan on it. And they live in 2 of the bedrooms. It's a 4-bedroom house. They rent out the other 2 bedrooms to their buddies. They're like, listen, it doesn't cover our whole mortgage, but it covers a lot of it. And I think the experience they got from doing that deal
it's the same thing.
Will make them a ton of money tenfold down the road.
Even if it doesn't, it's the same thing. You did a good job. There's places where you just can't find multifamilies where you want to actually live, and you got to do that route. But that's a sacrifice. Right? At this stage in my life, I have a wife and I have a kid. I can't live with roommates living in other bedrooms.
Damn.
When you first get started, do that. Sacrifice a little bit, because I promise you, it's not only going to give you experience, it's not only going to put more money back in your pocket, it's going to set you up going forward when everybody else was spending $3,500 a month in rent living in a city, which is pretty average today. Probably even in Nashville. You want to get a nice place that's renovated, you're probably spending $3,500 to $4,500 a month. And that's, and if you have a good W-2 job, you can pay that. But I guess what? You got nothing to show for it at the end. I bet you that $450,000 house today, I don't know when they bought it, but I bet you it's worth $650. You know, I got a buddy who he's a Navy SEAL, and he bought a house in Stony Brook, right by the college. I think they paid like 400 something thousand for it, like right around COVID time, and they rented it out. They rented the students, made some good money. They just sold it. There's 3 partners. I think they sold it for $650. Like you can't save that type of money. No. You know, like he's probably walking with 80 to 100K, and you know, plus the money that they put into the property. Like, you can't save that with a regular job, you know, and that's cool. That's fine. But that's why it's so important to just sacrifice a little bit.
Job.
Right. And he's a hustler, you know, he does some other stuff, but now he's fully deployed or he's about to be deployed, and it's smart. Like, I don't know another vehicle where you can do this that you're not giving your entire life to it. Yeah, you want to go out and start another company, you know, a drop shipping company or an Amazon business. Trust me, I did it. It's not that profitable. The truth is that's a full-time commitment. Buy a piece of real estate, put some good tenants in there, manage it. You know, if you have 1 or 2 properties, it's not nearly a full-time job.
And don't think or try to get rich or make that kind of spread. You know, he's talking about arguably the greatest accelerated increase in value in real estate in a 3-year window ever. And that guy also, it took him 4 years to make that kind of money. You're not going to make it in 4 months. Do the deal. I'm very pro do the deal. Just get your feet into the water. So much you need to learn about, from management to renovations to understanding debt, loans, and finance. When you come out on the other side in 12 months from now, the tools that you're going to take are going to make you 100x what you could have learned in any book or course or a library or watching YouTube videos.
Or listen to Scott and Sam.
Or listen to Scott and Sam, especially. You know, I'm the pinball here. You're Mr. 3.5%. I'm Mr. Pinball.
But before you move on from that, I want to
listen again. I'm moving in.
Shut.
I just want to let you know. I just sold my house. I'm moving in. My wife and kids are not coming. They're probably going to leave me. But we're going to house hack. We're just going to house hack your house.
No, we're not. But real quick, before we move on from that, I talked last week about getting your real estate license for 3% on a purchase, so you're 0.5% in. That's cool. The more important reason to have your real estate license, if you don't operate in real estate every single day, consult with your accountant here. But if you have your license, they consider you, and the IRS considers you a real estate professional, which means you can write off unlimited amounts of, I don't know, whatever.
Consult with your tax professional, but there's a lot of tax benefits to it.
Yeah, there's no limit.
Licensed realtors and
there's no limit in terms of how much you can write off, like on losses on your properties, if they're legitimate losses, obviously. But there's no limit. But if you are not a real estate professional, I think it's like $8,300 or something like that. It's very, very low. So, and if you're buying real estate, you know, a huge part of the cash flow is the savings that you're making on your taxes. So just
I would say get your license if you're serious about it. Like if you're serious about investing in real estate, you want to be in the real estate game, like absolutely. There's a ton of benefits to it. If that is just like your one step to try to tell yourself you're serious to getting into it and you have $1,500 to your name, I wouldn't advise getting your license because it's probably going to cost you that. And then you're not going to have any money or anything to do with it. But if you have some money, you have active income, like Scott said, this all starts with active income. You have to make a living and you're serious about it. You're committed to it. Yes, the benefits greatly outweigh the cons, but you got to be serious about it. You got to be willing to actually put it to work and get a return on your investment. All right, next thing I want to get into is how you've seen everything progress with our debt. We are taking on probably what the average guy would consider a lot of debt. You know, we've talked about this in the last few weeks where, you know, I don't think we realize how risk, you know, quote unquote, high risk, what we do is. And obviously, if you go into deals hoping that something's going to work out, that's not investing, that's gambling. But we are moving quick. We're buying a lot of stuff. We're flipping a lot of stuff, and we're borrowing a lot of money to do it from a bunch of different places. And I feel fine. I don't lose sleep over it, knock on wood. But what do you think it is for someone who wants to understand how to leverage debt better, how to raise money, get money, ask for money, qualify for loans? How do you think they should go about it doing their first deal or going from their first deal, maybe they live in the duplex now or whatever, they want to get into flips from purely a debt perspective?
Yeah, well, let me explain where things kind of changed for us personally, is going from primarily residential And I'm talking about like rental properties, not flips. But I guess flips is, there's a debt component there too. But residential to commercial, for the most part, you'll see this if you live in any sort of, desirable market. You'll be able to, like, there's a lack of housing. Like, there are people who need a place to stay. Everyone needs a place to stay, regardless of what the economy is. You might make a little less in rent, but as long as you have a solid product, people will come and rent your space. Now, with commercial, the same rules apply, but it doesn't happen overnight like residential. Like, I have a vacancy at a property right now. I posted it for rent yesterday. I have 3 people who want to see it on Thursday. So, like, when it comes to commercial, that's not always the case. And the reason I bring that up is because when you start to have large amount of debt service, and on commercial assets, typically it's larger, for one building than just a regular, multifamily, duplex, fourplex, something like that. You are servicing the debt while the time you find a tenant. And you could do everything right, but if you don't find the right tenant, now putting the wrong tenant in there can be more of a headache than putting the right tenant in there, especially for commercial. So long story short, I think that's what Sam is alluding to as to like why we're having this conversation. Because, if you owe $10,000 a month in debt service
debt service is just a fancy way to say it's what you owe the bank, the lender, the seller, whatever. It's your mortgage payment essentially.
Right. So,
and in commercial, it does not include taxes and insurance.
Usually not. So if you're going to float that, you got to realize how many months am I going to float that for? And then same thing with flips, right? Like you have a payment on your flip, and like I'm doing a project now, it's taken like 8 or 9 months, and you're paying that every single month on top of all the construction. So, and if you have 15 flips going on at one time, and each payment's $1,000 or $1,500, like you're servicing $15,000-$20,000 a month just in interest, because they're usually interest only. So we've been talking about recently giving up portions of the deal, more equity in the deal, in order to bring on an investor who will basically bring in all the money. We'll use an example of a deal that we're looking at in New Orleans, or right outside of New Orleans. It's a $2.3 million purchase. We would, if we go with the owner financing route, we're financing $1.9 million. So we got to put $400,000 down. And the monthly payment comes out to be $10,500 a month, interest only. There's tenants in place, but it is a value add property, so that won't cover the $10,500 because obviously there's other expenses that will come along, just maintenance and lawn care and utilities and all that stuff. So the other option is go out and raise $2 million or $2.3 million, and you pay them something called a preferred return, which means you only pay them if the money is there to actually pay them. You can't do that with the bank. You can't call the bank and be like, hey, I don't have it this month. They're like, yeah, no problem. Just pay us what you got. They don't do that. So if, with a preferred return, now the other downside of it is you're giving up equity in the property. But, if you have enough of them, that's how we look at it. We'd rather own 30%, cumulative over 30 assets that are all worth $3 million a piece than own 100% of 5 assets that are owned worth $3 million a piece with the risk involved.
And be on the hook for all that debt service. So you got to just look at it from a holistic point of view, and you can't be a Debbie Downer. Scott made a really good video about this the other night. Sometimes we ask the opinions of older people, wealthier people, more experienced people in real estate. Most of the time, they're going to shit on the deal because they already are set and they're cash flowing from a major portfolio worth 8 or 9 figures. And they view this project as, why would they waste their time or their money? It's so much, it's such a lift. The upside is predicated upon X, Y, and Z happening. When you're in our shoes, what we're trying to do is just build a really strong resume and load up our experience, so that when we go out and we have a fund, and we're fund managers in 24, 36 months from now, and we go sit down with a private equity firm or a hedge fund or whatever, and we ask for $30 million, we have the resume to do it, and we know exactly what to do with the money. And we can service our clients well and grow our fund and make it really mean something. But you can't do that by just flipping houses. You have to do bigger projects. And if you're doing the bigger projects, you have to be extremely tight on your underwriting, and including in maybe the most important part of the underwriting is the debt service that he's talking about. So there's a lot of opportunity with owner financing right now because bank rates on commercial loans are 7.5%, 8% plus. And you can go to an owner and offer them 5, 5.25%, 5.5%, which is what we did in that deal that Scott's talking about, and it's really enticing for them. They can make hundreds of thousands of dollars in interest over the next 5 to 7 years. And if you want to make it even more appealing to them, you really want the deal, you really see the upside, tell them it's interest-only payments. So you're not knocking any principal down in that $1.9 million loan amount. And they're just making straight cash, homie, for the next 5 to 7 years. And you still owe them $1.9 million when the clock strikes due in 5 to 7 years. The problem with that is, whether you had the 400 grand or you got to go out and get the 400 grand or whatever, you're either tying up a ton of cash that you're not going to get back for years if you ever do get it back, or you're now raising cash that you need to also pay interest on, and you're going to pay every bit of 8, 9, 10% on that money. So
you could do a pref on that. We've done.
You could do a pref on that, but now you're prefed behind your debt service. Everyone goes in a line. That's all it is. So, number one, this guy's not going to sell you this property on owner financing unless he's in the first position, which means if anything happens, you get hit by a bus, you default, you stop making payments, he gets paid first. Number two, your investors. Number three, if you get a line of credit against or whatever, everyone goes in line. And number one is always going to be the owner. And it's very hard to get second and third position debt. But if it's tight like this one, the more and more we dive into it, it makes so much more sense for us to do a pref structure where, yes, we're going to give up 50, 60, maybe even 70% of the deal in equity, but can we get this deal for no money out of our own pockets? Do the lift, operate it over the next 16 to 24 months, offer someone a 7 to 8% pref, and get the experience under our belt, get the deal on our resume, and use the tools that we get from this deal to go out now and do a $6.4 million strip center next year. That's all this stuff we're doing. Scott made a video last night about how we're increasing the value in our RV park by owner financing campers. You know how we learned how to do that? By owner financing a house. We learned how to buy the house by, doing novation deals that it all works back, and you just take a small tool and add it to your tool belt. And as long as you're willing to keep progressing and not just settle for where you're at, you're going to take those tools you learn and leverage them 10x, 15x into whatever you do next.
Yeah, what's funny? We were talking like last week about the term the promote. Mm-hmm. So like this is like a term that's thrown around a lot. Like I had a guy who we interviewed, and he was like, "So you get paid on the promote?" And honestly, I was like, "I don't know. I didn't even know what the fuck that meant." But the truth is, what that actually means is like basically you give up a percentage in the beginning, right? So like if you're giving a pref, which is like 8%, so if the asset provides 8%, the person gets paid first, and then past that it's 80-20. Right, so like we get 20%, they get 80.
Or whatever split.
Whatever you can negotiate. But like typical is like 80-20. And then it goes to 9% or 10%, then it jumps to 70-30. And that would be the promote. So you're getting promoted up to another 10% equity in the deal, essentially. And it could go all the way up as high as 50-50, even 60-40 the other direction. And that's where the operators like us make the majority of the money. So we're incentivized for the deal to do better and help the deal and everything we can to make it bring in more money, and in turn we make more money, right? So if you heard the term, you're not sure what it was, I didn't know either. I've heard it thrown around so many times, but
there's so many terms in real estate. Even if you're buying your first flip, all the way up to commercial deals or doing a fund, there's so much terminology that a lot of these guys use to throw around. Most of the super uber successful guys in real estate, I'm not talking about the billionaire fund managers. I'm talking about the guys that you see every day in your market. Most of them did not go to Harvard or MIT. There isn't really, maybe there will be in the future. Maybe we'll start it. We should start the program at Washington College. But there is not a direct education track as it currently stands to go and have a super successful career in real estate. You want to go work at a hedge fund. You want to go work at JP Morgan. To study finance. To study business.
There is. Yeah, there is.
There are real estate certificates you can take courses in real estate. I've looked into the real estate programs at local colleges around here. It is
I know
what I would advise teaching people.
It's not for what we do. It's for like what like a Tishman Speyer or like a company like that is doing.
Yes,
like
if
all
you
of those
sit
people
at a desk at $1 trillion company or whatever.
Right,
It will
exactly.
help you out. Yes.
It's not what we do.
No,
if you want to learn, subscribe to Sam and Scott. Okay, if you want to learn,
damn, Sam's going first now.
That's right, Sam and Scott.
Oh yeah.
What were you saying?
What my point is, you don't have to feel like, because if you're watching a video and Grant Cardone or Scott Matthews are throwing around all this terminology like debt service and stuff like that that you don't understand, most of them are just fancy words for simple terms that I'm sure you know, right? Equity is the amount of money that you have in a deal, whether it's money that you put down on the loan or it's equity that you have gained because the asset has appreciated. You have that much more room, that much more space, right, in the deal. The debt is the part that you don't have, that you've taken from someone else or a bank, private lender, whatever. Equity and debt. Debt service. You're servicing the debt that you have, the monthly payments, whatever you're paying them in principal and interest. Escrow. It's just a part of the loan that makes up principal, interest, taxes, and insurance. It's not that complicated. Continue to educate yourself. Listen to Scott and Sam Real Estate. Watch Scott and Sam Real Estate. Listen to other podcasts and videos. I know a lot of podcasts on real estate can be brutal listens. Trust me, I've been there. When we bought an RV park, I was listening to RV Park podcast nonstop. I wanted to lose my mind. That's why we're trying to have, a better podcast. But consume the knowledge. Everything can be learned. Everything. You got to start with something small and work your way up. We are, if the scale is 0 to 100, I would put Scott and I right now at like a 12. And we've done a lot of shit.
That seems high.
Damn.
I was thinking like a 5. But yeah, you just got to get started, man.
Yeah, you got to get started. You got to do the deal.
Started.
We get so, it drives me fucking, I'm curious on your take on this. You got a DM the other day, nice kid, good kid. He's, we asked him, where are you at? Where are you at in buying your first deal? Oh, I'm saving and I'm strategizing. Okay, the saving thing I get. Like, if you have $500 to your name, I would not kill yourself over saying I'm going to be a real estate investor in the next 6 months. I'd probably kill yourself over... Not literally kill yourself. I mean, work really hard toward making more active income. You got to get your active income together first.
What you can do in real estate.
Strategizing thing
is like real estate.
A lot of strategy. The strategy component is kind of what drives me nuts because who strategizes? Tishman Speyer, J.P. Morgan, Turner Construction, $1 trillion companies being ran by the most brilliant people on earth. Yes, they have a strategy. You will develop your strategy from experience. Doing well, from fucking up, from making money, from losing money. You will develop where you want to go. You know how many deals we had to do to figure out just what the heck we wanted to do? And then when you come up with what you want to do, you work back from there. And then everything becomes so much more enjoyable and clearer. Do the deals. By doing the deals, you will paint the picture of where you want to go.
Let me talk about something that is, we might be wrong for this. I don't know. But a lot of people who don't do deals, brokers, people just getting started, they always ask, so what is your investment criteria? And they go, what type of IRR are you looking for? Your cash on cash return, your cap rate, all this stuff. And it's like, yeah, those are all things that we look for sure. But to be completely honest, the majority of the stuff we've ever done, it's just like a gut feeling, which might be stupid, but for the most part, they have worked out because the biggest thing is the numbers are the numbers for sure. And I'm a numbers guy. I look at them
gut
all.
Feeling. He's saying gut feeling after you've done the full model, the full financial model and the underwriting.
Right. Exactly. Thank you. So if the thing checks the box in terms of the numbers, there's no I need a 20% cash on cash return. It's not a thing. The area is dependent. The tenant base is dependent. The cost of the project as a whole is going to factor all of those things. And I'm going to look at it okay, is there profit to be made here? Usually 25%, right? That means I could get my money out of it or I could sell it, right? Because you can take it to a bank, cash out 70 to 75%, so I can get the majority of our money out of the project. That's number one. Everything else is does it cash flow in terms of all right, are we going to make some money every month? We're going to put in $100,000 and we're going to make $3,000 a month in cash flow. Okay, $36,000 a year. Not bad, right? Not amazing, but I'm going to continue down the process of this deal. And then I'm going to be is this something I actually want to do on a regular basis? Do I want to go to this damn project every single day? And if the answer is no, then I skip it, even if it fits the...
And what's the return relative to the amount of time you're going to have to spend on it, right? Honestly, what got our gears turning on a lot of this stuff was we had a deal a couple years ago that came our way, 10-unit apartment building, 5 hours away from Scott in a market that we did not know. And there was very little for the present day value to justify buying this thing. And we tried to move it. We tried to wholesale it. Nobody really wanted it. I think one guy offered us what, 15 grand to move it or something like that. Like it wasn't.
Well, yeah, I'll add to that in a second, but keep going.
But my point is, there were 15 reasons why not to do this deal. But the guy was willing to owner finance it to us for no money down, for a very low monthly debt service. I want to get fancy.
It was just
And
his mortgage payment. He was like,
it was
take
his
over my
mortgage
mortgage
payment.
payment of 1800.
He was like, I'm just done with this fucking thing.
It made no money.
I know it needs attention. It really just needed time. It needed money. It did need money. We spent some money on it, but it needed
like
just
10,
time.
10K a unit though. 100K.
The biggest thing was just who was willing to put the time in, the effort, and then when we got through it and we did the refi, it was worth it. We made a lot of money, like a lot of money that was way more than we would have made wholesaling it to that guy. But it took a year and a half and a good amount of money to get there. But it all just came from looking at each other and saying like, yeah, there's 10 reasons not to do this thing. There's 6 vacancies. There's 2 pending evictions. There's all this stuff wrong. It's not in a great area. This thing's never going to be worth $5 million. But there was 3 points, which was the renovation budget wouldn't kill us. We could take our time with it because the monthly debt service is low enough that it's paid by the asset. We're getting it for no money out of our own pockets, no money down. And if we pull this thing off, if we just hit X, Y, and Z, we should be able to make this much on a refi.
Well, let's break down the numbers. If people are still listening, let's break down the numbers here.
All right.
So
Shout out Rob Sells Miami.
let me tell you why wholesaling is actually a great place to start. We take this asset in a market we don't understand, where it's not our market. We send it out for about $100,000 more than we paid for it. Actually, 130. We don't really get any calls except for one guy. He goes out and sees it, and it was for $330,000, right? I think we had it for $300. So it was a tight deal as it stood. He goes to the asset, walks around, he goes, man, it nees a bunch of work. He goes, if you could go back to the seller and get some owner financing terms, I'll do it at like $225,000. So like we have to go to owner financing and get $75,000 off before we make a dollar. And I was like, well, good luck. Like we'll call him, like, we'll see where he's at. We call him up, takes a bunch of back and forth. And he goes, yeah, you know what? I owe 200 or I owe 220 or something like that, or like 210. And he's like, if you just take it over, that's fine. And I go back to the guy and I go, he's not willing to do that, but he would probably do like 240 with owner financing. And he goes, I'll take it. But before we had it locked up, and I go, and then Sam goes, I think we should buy this. I go back to the guy and go, I'm not really interested. He goes, I'll put $50,000 down and I'll take it. And just then I realized, I was like, this guy wants it so bad now, we have to take it, right? We have to do this. And then Sam talked me into it because I was scared because I know it's 5 hours away. I have to be driving to
I've never been there to this day.
Yeah, thank you. I got a speeding ticket going back and forth, and I paid for it out of my own pocket. Thank you, Sam.
Hell yeah.
Yeah, hell yeah. Long story short, so we bought it for 220 or 210. We put $100,000 into it, and it appraised for $590, like right under $600,000.
Something like that, yeah.
$575.
Essentially exactly what Scott modeled it when we bought it. He was like, but if we just do this, this, and this, and they traded these caps, all these valuations are based off of income for these kind of assets. When you start getting into multifamily commercial, comps mean very little. Income means everything. Net income means everything.
Yeah, so we filled up the property. We got 700 a door or 750 a door? 700
to 750, yeah.
Yeah, 700, I think. So
separate water and electric meters. Tenants pay all their own utilities. That is gold.
Yeah, that was gold, yeah. And it's, it's technically making $7,000 a month. Now we have some late tenants and stuff like that. So we don't actually make $7,000 a month, but it's pretty close. And in the eyes of the bank, that's all they need to see to value it at like $600K. $7,000 a month, $600K.
And they gave us 75% of that in debt.
Yeah, which was like $430,000 or something like that. And we only owed $200,000. We put some money into it, and it was a good day, tax free. And now we sit on the asset, we still own it, and that damn property is the reason why I bought the car that I own today, because of that, right? Like you don't know, like you just it kind of you take the money out, you don't really need it, and you're just like,
sounds like I have some equity in the Porsche, at least an 80-20 waterfall, whatever the hell that means.
If you went to the property, yes. If you pay for that speeding ticket, maybe.
And we have a property manager. We have an awesome property manager in place, local. I don't know if we'll ever go back. Do you ever see a world that you ever go back there?
I don't know, man.
I don't know. If 50 Cent builds up, it's in Shreveport, Louisiana, 50 Cent. Shout out 50. If you're
50,
50 if
buying
you're
the block.
listening. Big fan.
Block.
All roads lead to Shreveport.
I still listen to 50 in the gym.
Oh, yeah. Shout out 50.
Shout out
Formula
50.
50. So the point is something like that. Owner financed, 10 unit, middle of nowhere, not a great market. It had little stuff. 10 electric meters, 10 water meters, off-street parking, corner buildings. It had a new roof. The guy just put new roofs on it. You find that stuff. Like, it's out there. And it's not perfect, and it's not around the block, and it's not going to be $10 to do it, and it's not going to get done in 6 months. But if you're serious about it and you're willing to put the time and the effort and the money into it, you can have days like that. And then all that stuff that we learned from there, we're now doing it on assets worth 10x that. And we still own that asset. Like, and we're not going to sell that thing. We just did a cost seg study on it. There's been so much positive, from the refinance to the cash flow to the experience to the relationship with the property manager to the cost seg, all this stuff that has come out of just being willing to do the deal. There was no promise it was going to work. There was no, it honestly was, the first like 6 months we owned it was terrible because we were trying to do it all remotely. Finally, Scott was like, I'm going to get in the car and start driving up there. And he went up there a few times, and that made all the difference. You got to be willing to do it. And if you do it and you have a plan, and throughout that plan, you have to understand there's going to be a lot of downs and not many ups until the very end of the plan. You just got to keep sticking with it. We're going through it right now with multiple other projects.
Yeah.
But
shout out RV Park.
so when he says gut feeling, he's talking about we can sit down and we're going to do an IG Live today at 5 p.m. Eastern. I'm going to make another YouTube video. His kid Jack sent me a fourplex that just went on the market on Zillow. He wants me to break down. I think it would be a really good video for us. Shout out Jack. It's not a deal. 375 in that area. No go, baby. But we're going to break it down anyway. I'll tell
What
you what
area
we would
is it?
offer. It's in Downingtown, PA. Downingtown.
75 for four units, less than 100K
yeah,
a unit?
no,
It must be
no.
messed up.
It's just, we'll get into it. Another video. The point is, you can sit down and model 100 deals, and you're going to have 100 different spreadsheets with a bunch of different cells and all this stuff that says, like, it's a 10% IRR, cash on cash
I used to
return.
do that.
Listen, dork.
Before I bought anything.
Listen, dork. You don't need to check every single box. If you have to check every single box, you will never buy anything, ever. You are not a $1 billion fund. Like, you can't afford to buy one deal a year or one deal every 3 years. We need to be buying, we buy a house a week, and we probably buy a commercial asset at this point every 2 months. And that's, you want to quote, not have a job? That's how much volume you got to do. And we're still not fucking driving Lambos. And I really want a Lambo. I'll settle for a GX. You can do 100 spreadsheets. At the end of them, you have to be willing to look at the spreadsheet, look at the asset, and look at all of the real life information you have. It is so real life. And then ask yourself, do I want to do this? Am I willing to do this? And is it worth doing this? And if your gut is being like, you should do this, then just do it. Don't worry about what the fucking spreadsheet says. And then gaze at the spreadsheet, because that's going to be your plan. That's going to be your template when you're 6 months into the job, 8 months into the job, and you're like, this isn't going great. I got more vacancies than I thought. Well, actually, I budgeted for this. Actually, I knew this was going to happen. And that spreadsheet should be based off of real life data, not what you hope happens. Take it from your boy who hoped that a duplex would appraise for $275,000. So I talked Scott into buying it, and then it appraised for $225,000, and we figured it out. But it was tough sledding for your boy. All right, your boy got chewed out on the phone. Pretty good. All right, that's enough real estate talk for the day. Okay, I'm tired of it. Tired of talk. All we talk about is real estate. I want to talk about
awesome.
To wrap it up.
Sam's having a kid tomorrow. Shout out Sam having a kid tomorrow,
and I'll be right back at work on Friday.
Yeah. Thank you. Thank God.
Miss me with, let this be a real life example. Yeah, I might call contractors, bankers, vendors, accountants, lawyers. I might call you at 8, 9 o'clock at night on a Wednesday. I'm sorry, but we pay people a lot of money. We pay our bills on time, and I don't ask anyone to do anything that I don't do. I'll answer the phone at 8, 9 o'clock. This is all that matters. We don't, like Scott said, we don't have jobs. I'm going to keep leaning into that. That's a t-shirt right there.
Yeah. Jobless.
Yeah, jobless. This is all that matters. Like, if this doesn't work, it drives me insane. Like, I get chirped by quote unquote buddies of mine sometimes of like, you work too much. You should spend more time. Da, da, da. Listen, if I don't work too much and I don't work money and I don't make money, then my son doesn't have that finished basement with a nice bike. And my wife doesn't have that car and that great health insurance and all that stuff. This is what makes everything else go. It always comes first. Always.
Sam also has very little chill, though. Like, You'll learn
No
this about
chill.
him.
No chill, Gil.
No chill. Like he
No
is
chill, Gil.
ruthless. And
I
I'm
am-
kind of the opposite of that. I like to let people, live their life. 8 p.m. at night, don't call me. You especially, don't call me.
I think, yeah, ruthless is a tough. That's a tough label to put on your boy. I would say
I've seen it though.
I see it very. But I think you could also say I'm the guy who I would never not pay someone. I would never pay someone late. I'll always be. I give you my
Oh,
word.
yeah.
It
Oh,
is
for
gold.
sure.
It is rock solid.
For sure.
If
There's
I
a
believe
trade-off
something
here.
is the right way morally, I will do it over and over again. However, if I feel like you are shortchanging your boy or, not giving me your best, I will let you know. And I've just learned that over the years. I am happiest, most productive, and really just happiest when I live that way. Not saying it's right, but it's what works for me. When I settle and I try to, you know what, yeah, I should take that time. I should go watch that game or eat that food, drink that beer. 24 hours later, I'm always like, why did I do that? Like when I'm ripping and optimized and working a ton and doing what I want to do and locked in, for lack of better words, I am happy as a clam.
Yeah, there's got to be some like reset or rest time that you enjoy.
Yeah, I want a villa in Nizook for a month. I
Shout
keep
out to
telling you
Zook
this.
in Cancun. All right, if y'all haven't been, if no one's been there, I know you hear Cancun, you're like, oh, that place sucks.
Oh.
Hey, it is the best resort in Mexico. I think it was voted the best resort in Mexico at one point.
I voted for it. And the fact that we haven't gotten
Can we
any
get some free rooms?
free game, yeah, crazy. I went there on my baby moon. We went there for another, maybe like
I went
after
on
we
my
got
baby moon too,
engaged or something. I don't know, but A plus. Who was just there? What's his name? Who's the boxer with the fake abs?
But yeah, you sent it to me.
Golden Boy. Oscar De La Hoya. Oscar De La Hoya was just there. If Oscar's willing to go, come on, Oscar's got some coin.
Oh, that
It's-
place is fire, dude.
Yeah.
You could spend some, but you could also do it affordably.
Yeah, just don't eat. Yeah, just don't eat.
Well, yeah, semi-affordably. Go in August.
If you just don't eat or drink or breathe, it's pretty affordable.
I mean, affordable.
You're
is a
willing to
relative
walk to
term
and from the airport.
at a 5-star resort, but it's not like you can ball out. Like you get the villa, spend $12,000 a night on a villa. Like you could do all that. Those
Let us
people are
predicate
there.
this and say that we don't do that. Yeah.
No, we do not do that. We do it the most affordable way possible. Is my point, but it's worth it.
Yeah. And I
it's worth
also
it.
am at
Shout
the
out
point
Scott
in
for
my life.
introducing that to Sam,
I would rather
and shout out my wife.
not go on vacation for a year straight and then the second year go on a vacation like that than just go on like some,
Carnival cruise.
oh my God, bag of milk, cheap $1,500 total trip, all inclusive. I've been there. Like, dog, I want to
I've
be
never
left
been there.
alone. I don't want, like, you know me. Like, you think I'm tough to be around the workplace. When I'm on vacation, I want dead silence unless I make the noise.
Dead silent. This dude is screaming at the pool.
Yeah,
Screaming.
again, if I make the noise. Dead sober.
Right.
Dead sober. Like, I don't want drunk
Yeah.
people around me who are sunburned and stuff like that. Nah. I want beautiful people surrounding me.
Yeah.
All right? Men and women alike.
Money brings beautiful
Yeah.
people.
I want someone to jump in cannonball and you just hear like, bloop. Like, that's it. And I'm the cannonball.
Because the guys working, they keep the splash down. They run over and they cover
the
it.
hombres are
Yeah.
knocking the water right back in the
All
pool.
our amigos,
But
yes. Those guys are awesome. Shout out to them.
shout out to Nizook. I'm working on a couple collabs. I'm really pushing the Home Depot end. We spend more money at Home Depot than I spend anywhere else in my entire life. It's insane the amount of money we spend at Home Depot, and the fact that we are not doing some collabs with them, that's going to change. Bigger Pockets, too. I'm trying to get a collab with Bigger Pockets. Your boys grew up on Bigger Pockets.
Yeah, we
Scott and I have
did.
been reading and listening and watching Bigger Pockets content for 13, 14 years. We should get involved with Bigger Pockets. And we got some other cool stuff coming up in our podcast. In a couple weeks, we are doing a podcast with the Phi couple. It's Ali and Josh Lupo. They have a huge social media following. They were on Fox News a couple weeks ago. Their content is really good. I think it's going to be really good for our listeners at this point, probably just our moms. But I really like their content. It is a portion of the bucket of the stuff that we talk about. You got to have money available to buy real estate. In order to have money available, you got to be financially conscious and financially literate. And their entire brand is built around that.
Shout out Josh for telling me, have you ever considered buying a good deal? After I said Burrs.
Oh, I'm gonna bring it up on the
of
pod.
course. That's the only reason why I want to talk to them.
On the pod. Hell yeah. I also have kind of, we have a couple videos that have a couple 100,000 views on them now at this point. And some of them are, Scott saying people can't learn to ski as an adult, me saying that people got laid off because they were working from home and lazy. Listen, I'm just giving my personal opinion. He's giving his personal opinion. Not saying that we know everything, but some of the comments are wild. But I promise you, it will never rattle us, and you will never, ever see us responding because there are so many more.
He's responding right now if you haven't realized
there are so many more positive things that I have come. But I can see how people get wrapped up in it. They have a big following, and they get negative hate and stuff. I could see how it bothers a lot of people. But I'm pretty amazed where we have like 5,500 followers as of right now, and we are getting 6 to 10 DMs a day and like 100 new followers a day at this point. And it's already leading to business for us, opportunities for us. I can't imagine like these guys and gals who have 100, $200,000 followers must be making so much money off social media.
Yeah, I mean, I guess if you
and that's 100, $200,000 followers.
Yeah, I mean, I guess you're talking about like brand deals.
Yeah, I just didn't realize how
serious you should take this shit.
Yeah.
Same.
Yeah.
The reach is insane.
Yeah,
you don't realize it. You don't realize that you get 5,000 views on a video, and you're like, that's 5,000 people that actually might have watched your stuff that are looking for your type of stuff. They're not just random.
Or it's just their moms watching it 2,500 times each. And the time commitment's pretty serious. I probably spend now like 3 to 4 hours a day on social media related stuff with no immediate return or really a plan to get a return. But that'll come with time.
Yeah.
All right. Well, episode 4, Instagram Live tonight, 5 p.m. Scott and Sam Real Estate on all platforms. Thanks for listening.
We're breaking out a deal, I think. Right?
Oh, yeah. We're going to break down a full commercial deal, a real deal we're trying to buy. And
the gut feeling.
Yeah, and the gut feeling and how we came up with that gut feeling and why.
Listen to it, the intuition.
Continue to message us. You want to have a meeting, one-on-one, two-on-two, one-on-two, whatever. You want to just talk to Sam, just talk to Scott, just DM us. We'll figure it out.
Sam charges $100 per hour. I charge $500. So
live streaming the birth of my daughter tomorrow.
Oh my!
And then live streaming my divorce on Friday. All right, episode 4.
Oh my God.